Hey everybody, I'm Brian Gallagher. I work on the investor relations team here at F Street, and I have with me Lane Guger. We're going to be talking about depreciation today and how that relates to investing with F Street, investing in commercial real estate. This is the hidden tool that all of the savviest investors are using. Depreciation helps lower your taxable income, and we're going to really just dive into what exactly is depreciation, how can investors use it, and how can that supercharge your investment portfolio and help you get to that generational wealth sooner.
Great. Awesome. So many of you know F Street. We're an alternative real estate investing firm. We're focused on building long-term wealth for our investors through passive alternative investment income. Scott Louie likes to say we are planting money trees for you, and hopefully today we can expand on exactly how we can help you do that.
So we have almost 700 million, 668 million assets under management just on our commercial real estate side of the business. We also have about a $100 million private debt fund that I'm sure a lot of you are familiar with as well. We've been around since 2009. We have assets in over 10 states and growing. We're about to add Arizona as a state that's in our portfolio. We have a great team here. It's not just Lane and I that we have Scott, the founder, Josh and Nick, our other principals, and a whole lot of other team members that are, really helping us deliver great results on a daily basis. Yeah.
Some exciting stuff. We've been really busy lately. We have some upcoming acquisitions. All of these are fully raised. As Brian mentioned, F Street Yuma will be our first asset in Arizona. We're extremely excited about that huge value add opportunity. We have an acquisition in Normal, Illinois, right by Bloomington, middle of the state. Great asset. It's got a credit tenant in there for the next 10 years, so our investors can expect to see some great cash flow from that going forward. We also have F Street Iron Block, which is a downtown Milwaukee medical office building. We have a great absolute net lease in there for the next 15 years. We're very excited to close on that. All these will be closing in September in the next few weeks here, all fully raised, and we're very excited about these and hopefully more to come before the end of the year.
So is your portfolio missing something? This is something that a lot of investors are, hey, am I properly diversified? Am I investing in the right things? Everyone only has a finite amount of dollars to invest. So you want to make sure that those dollars are, put to use correctly. So traditionally you'd have, call it 60% in stocks, 40% in bonds. In the last, call it 10 to 15 years, we've seen alternatives, whether that's commercial real estate, crypto, or private equity investing has really grown in prevalence. And there's a lot of information out there from different companies and different investment strategies, and navigating the whole space of, hey, where should I be putting my finite dollars is a question that a lot of people are asking. And many investments can give you great returns, but not every single investment is going to give you tax advantages. So you're putting your dollars at work. You're hoping to get a good return on your money. And if you get that money, that you get those dollars in your pocket, do you want to, give Uncle Sam 30% of that and, just wipe it off to the game? Or do you want to, find ways to optimize those returns and pay less taxes?
Yeah, we had an awesome dinner with some of our investors last night, and one thing that resonated with me is Scott, our boss, mentioned that, hey, all these ultra high net worth rich people, they don't pay taxes. Try to be as much like them as you can, right? Because they're the ones who wrote these tax codes. Let's take advantage of them if we can. So we're here to try to help you do that. We should preface it by saying we are not tax professionals at all, even though Brian might try to tell you he is. But take everything we say today with a grain of salt. Make sure to do your own research, talk to your CPAs, etc. But we're going to do our best to explain to you how we can help investors take advantage of some depreciation today. So what is depreciation? Many of you have probably heard of it. Many of you have a decent basic understanding of it. But it's really what the IRS allows real estate investors to do is deduct wear and tear from these real estate assets that you're invested in, right? And even though we like to think most real estate appreciates over time, the depreciation in our tax code allows you and us as your investment managers to deduct value of the property each and every single year, right? So just a very basic example, looking over here, if you have rental income from an asset, say you're invested in F Street Yuma, and based on how much you invested, you're going to expect to receive $10,000 of rental income this year. So investing without depreciation right? You have $10,000 of income. You have no depreciation offsetting that income. Your taxable income is $10,000. You say you're in the tax bracket where you owe 30% on your passive income, and then your net cash flow is $7,000. That's fine. It's good, right?
Yeah.
Might be if you see a 10% profit on a stock for a year, that's exactly what you're going to end up paying, right? Now, with real estate, a lot of times we're able to offer a depreciation deduction, which is offsetting your taxable income of $10,000 here. Your depreciation offset is 10 grand as well. So your taxable income is zero. 30% of $0 is $0 still. And at the end of the day, your net cash flow is $3,000 higher than 7,000. It's 10. So that's a very basic example of what depreciation can do for you. And Peter, do we have a question?
That's a great question, Bob. This is actually, yeah. So the question is I just sold a duplex. I have about $80,000 in capital gains taxes that I'm looking at having to pay. What are the strategies that I could use to offset that? So this is actually a term that we came across in the last year or so called the lazy 1031. So if you're familiar with the 1031 exchange, you have 45 days to identify a new, call it duplex, to buy, up your basis and defer all those capital gains. And we do help a lot of investors with 1031 exchanges. But the lazy 1031 is essentially, I'm going to invest into a real estate syndication or a different piece of real estate. And even if it's not a true 1031, I'm going to do a cost segregation study, which we're going to get into in the next few slides. I'm going to get a lot of depreciation in that first year and help offset that gain. Even if it's not all of it, it's better to offset, half of it or most of it rather than just taking, the full $80,000 hit on the capital gains.
Yeah. Pay as little taxes as you possibly can.
Absolutely.
Yeah, and feel free to reach out to us after this. We're more than happy to have a conversation about how you can invest with us and potentially help offset those gains.
So as I just said, we're going to go over cost segregation studies. What are these? You've maybe heard this term before and don't know exactly what it means. So this is a study that instead of just accepting that, hey, my real estate is going to depreciate on a 27 and a half year schedule. So an apartment building, if we were to buy a 100 unit apartment building, each year for the next 27 and a half years, we can take that year's proportionate share and write that off as a passive loss. If you don't know what 1 divided by 27 and a half is, it's about 3.6%. So that's not a lot of depreciation each year. What a cost segregation study is going to do, it's going to take all of the little things that make up that apartment building. It's going to take the HVAC system, the roofing, the lighting, the carpets, any common area furniture. It's going to take the appliances, the washers, the dryers, the stovetops, and the ovens in each unit. And it's going to assign those either a 5, a 7, or a 15-year property, depending on what the tax code says. And from there, the cost segregation study is going to forward accelerate these eligible 5, 7, and 15-year property that makes up your entire apartment building. And it's going to allow you to depreciate that on a faster schedule, giving you a larger depreciation in that first year. So what does depreciation look like if I invest, say, $100,000 each year for 3 years? So this example is, simplified just, for presentation purposes. But in the first year, I'm going to make a $100,000 investment. In the second year, an additional $100,000 investment. And in the third year, another $100,000 investment. So I have $300,000 invested. Each investment is going to produce $10,000. So as I have 100,000, it's going to be 10, 220, 330
of annual cash flow.
Of annual cash flow. So that's taxable income that you are receiving. Now, with depreciation, if we do a cost segregation study in that first year of each investment, I have $10,000 of cash flow here, but I have 30 grand of cumulative depreciation here. So really what that's going to do is it's going to make my taxable income zero, my taxes owed zero for that year, but we have 30 grand here and 10 here. What happens to the other $20,000? This is the best part about depreciation in my mind. The 20 moves here. And so that's, you're going to have $30,000 in depreciation from your second investment and then $20,000 rolled over from the previous year. So any unused depreciation in each and every tax year is going to roll over down and down and down. So in this, simplified example of 3 investments over a 5-year time horizon, if you're doing cost segregation studies and you're forward accelerating the depreciation, you're not paying anything in taxes because the way the tax code looks at your income and your passive losses, you have zero taxable income, all while you're getting over this 5 years, $120,000 in net cash flow. So instead of paying $36,000 if you were in another investment that is going to pay you $10,000 each year, and you make 3 of those investments over 5 years, with depreciation and with doing these cost segregation studies, you're actually going to pay $0 in taxes. And this is really the hidden power of depreciation, is layering on these different investments and understanding that any unused depreciation is a benefit to you. And if it's not a benefit today, it'll be a benefit tomorrow or next year. So we're happy to dive into this more. If you ever, want to really get nerdy about depreciation, Lane or myself or our CFO, Jordan, we're always available to chat. Looks like we have a question.
I'm happy to take that. So the question was, is the tax breaks that you're getting from the depreciation more of a deferral of taxes rather than a complete write-off? That is correct. So we're deferring these taxes down the line, right? So at the end of the day, we'll have to pay our capital gains or depreciation recapture tax. But essentially with this, there's 2 great things that you can do. One, you can somewhat change the tax bracket that you're in if we hold this asset long enough, right? So if you're passing these depreciation benefits down the line and we hold this asset for a long period of time, at the end of the day, we'll have to pay long-term capital gains, which has a much better tax rate than short-term capital gains, and it depends on your income level, what tax bracket you're in. But these depreciation recaptures that we'll be paying at the end of the day are now not taxed at a higher rate. They're taxed at the long-term capital gain level. And 2, we're not paying these taxes every single year, right? So instead of losing money in year 1 and year 2, not losing money, but paying Uncle Sam in year 1 and year 2 and year 3, we're now paying him potentially in year 5 or year 10. And that was just longer that you were able to hold on to that money and hopefully invest more with F Street, with other alternatives in the stock market, whatever that might be, right? You're able to use that money now that you wouldn't have if you had to pay taxes on it. So that's 2 really great things that we're able to do. Essentially form what tax bracket you're going to be in and defer your gains to a later date to be able to have more money in your pocket today. But yes, at the end of the day, you are deferring the taxes. You will have to pay Uncle Sam. Everybody does, unfortunately.
Yep. And just to piggyback on that with one small point is the time value of money. $1 today is worth more than $1 tomorrow, and $1 in a week and $1 in a year. So if you can defer these taxes down the line, the dollars that are going to be flowing into your pocket today are going to be worth more than the dollars flowing into your pocket in the future.
Yes, and that's exactly what Scott's talking about here when he says money trees. It sounds ridiculous, but it really is. Like everything that you can do here with the depreciation of each asset is a compounding effect that you're able to save more on taxes you're able to defer more taxes with each and every investment that you make, right? So that's what we mean when we're planning money trees. We're really taking advantage of this depreciation that our tax code allows us to.
That's a great question. So the question is, if we are buying an asset, so like let's say F Street Normal LLC, our property in Illinois that we're buying in a few weeks. If the previous owners already did a cost segregation study on that, are we able to do one when we purchase the building? The answer is absolutely, because when those sellers that we're buying the building from sell the building to us, they'll have to settle up with, Uncle Sam on their own accord. And then we're essentially starting from, call it day one or day zero, and then it is then our investment from that point forward. So, the cost segregation study doesn't carry forward. It's for each, owner of each asset. So if we're selling an asset, to flip the table a little bit, if we did a cost segregation study, owned a building for 10 years and sell the asset, the buyer of that building would be able to do the exact same thing.
The only application where this doesn't ring true is when there's an entity sale, which is rare, but it happens from time to time. And investors and investment companies will do it for certain tax advantages. It gets a little complicated. But that's when, if we were to sell F Street Normal LLC, but not just the real estate, we were selling the entity to a different group as well. Very rare that that happens, but it does happen from time to time. And in that scenario, I don't think the cost segregation would reset. But that's getting very granular
Yeah.
and into details and probably nothing we should be advising on.
And great questions, though. Keep them coming. We love having questions and this being an interactive experience.
Yeah.
So.
Yeah, the question is, what are the tax rates on recapture at the end of the day? So depreciation recapture funnels into your short and long-term potential capital gains taxes at the end of an investment. So when we sell the building, you've realized a gain, the depreciation recapture or what you've deferred to the end of the day is included in that. Now the tax brackets, I believe, range for long-term capital gains from 10, 15, and 20% based on your passive income or general income. And with the short-term capital gains, it's just dependent on your ordinary income. It gets treated as ordinary income. So that's why taxes are higher. And we likely wouldn't do a cost segregation for a short-term hold because you're just paying the short-term capital gains rates, which are your ordinary income rates as well.
And if you want to shoot us an email after this as well, we can forward you some materials that we have internally. I know personally I do not have the depreciation recapture percentages memorized, but Brian, Brian at fstreet.com and Lane at fstreet.com, we'd be happy to follow up and provide kind of specific the brackets and the percentages and all of that.
Question is, can you use depreciation against your W-2 income? And the answer is, unless you're a real estate professional, no. So only against your passive income if you're a passive investor. Okay, cool. So enough on depreciation. I hope we didn't bore you too much, but it really is a powerful tool. So I hope if you have more questions, you reach out to us, or if you understand it, keep investing, right? But let's talk a little bit about the Access Apartments. Many of you have probably heard of these, but we're really, really excited for the Access Apartments to come online this November. It's 156 units, 147 units. Our first phase of the project is going to be garden style, 42 units. It's what we're good at building, right? And then we're also going to be coming up with the second phase, which is 105 units that you can see here. Podium style building. It's beautiful. It's right on the corner of Greenfield and 92nd Street, which hence F Street 92 LLC. But it's a great building, 105 units there. We've got a beautiful little upper deck here that'll be looking over the corner of Greenfield and 92nd. We've got ample parking. It's going to be a great community. And we'll go through some of the details here with you.
So we're projecting really strong returns for this investment. So one of the metrics we really like to look at is, what is our stabilized yield on cost? What is the income we're going to generate in the first year of full operations at this building in relation to the costs it is going to take to build it? So our projected yield on cost for this investment is just a hair under 7.4%.
And this is actually slightly outdated. It's actually 7.48%. Sorry, I'm just
Look at that. Look at that. Mark that up, Lane.
It's outstanding. Do you want to explain what that is?
Yep. So we're going to essentially generate 7.48% of income in relation to the cost it took to build the building.
It's year one untrended, so we're not expecting increases in rents, just our base projection in rents and expenses. Our net operating income divided by the total cost to build the building. So if you get anything above 7% these days, it's fantastic. We'll go into explaining why we're able to capture above 7%, which has to relate to the tax incremental financing we're receiving to keep our expenses and taxes low. But 7.48, investors see that and they love that, right? Along with the 20% IRR and 2.0 plus X multiple, equity multiple.
Yeah, and then the market that we're building this in, obviously, we're located here in Milwaukee, Wisconsin. We do a lot of multifamily development all around the metro, and West Dallas has been a market that we've had our eyes on. There's been, there was a few other new apartment developments kind of about 5 years ago that were delivered in the market, and today they're fully occupied and see really strong, year-over-year rent growth. It's West Dallas is kind of one suburb out, so it's a really short commute. You're actually looking at two former West Dallas residents right here. It's a 12-minute drive, kind of traffic or no traffic into the city.
Close to Miller Park now, American Family Field, which is buzzing right now this time of year. Brewers are doing great.
Brewers are rolling. Yep.
But we're within minutes from the interstate here. It's easy to get wherever you're going, west or east, north or south. You can hop right on Highway or Interstate 41 as well. Really fantastic location for wherever you need to go. West Dallas is a great community. There's some wonderful city staff there that have just been making everything better lately, right? They are offering fantastic incentives to developers. That in turn is going to make this city great. As we mentioned earlier, we're getting a 27-year, 100% TIF incentive that we'll go over in detail in a little bit, but that really helps our project pencil out. You're going to experience some depreciation benefits on this project as well. We'll run a cost segregation study. And then obviously, multifamily rents are a fantastic inflation hedge. You have, instead of one renter like you do in an industrial building, you have 147 renters, hopefully, in this building that will go up with inflation. So that's why we love multifamily. But so that's our why. Here's our what. As mentioned, we have some great garden style apartments. Here's a wonderful rendering done by Rinka. And then over here, you have our mid-rise apartments as well. More renderings. I think we got some amenities on here. So we'll have a great club room, fitness center. Here's what our interiors. Oh, sorry, Peter, I messed that up. But here's what our interiors will look like, and a great a lounging club area.
Not to slow us down too much, but if you see all of the kind of the furniture in these renderings, the tables, the flooring, the appliances, just to circle back to the depreciation we talked about before, all of these items are things that we'll be able to assign as 5 and 7 and 15-year property, and that will depreciate forward and put less of a tax hit on you, and in turn more dollars back into your pocket.
Way to tie that back into depreciation, man.
So the tax incremental financing, as Lane mentioned, we have a 27-year, 100% of the incremental TIF package. So what that means is whatever the property is paying in taxes right now is kind of the base level taxes.
Property taxes.
In property taxes. We have to pay those, unfortunately. But the value of the property right now before we build this building is a lot lower than what the property value and the assessed value is going to be once the building is complete. So the difference in the taxes now versus when that building is complete and assessed at that higher value, all of those taxes will be 100% rebated in this case. There was a previous structure on the building or on the property. The city was instrumental in helping us acquire the property, and then also providing a demolition loan. So $1 million demolition loan at a low interest rate. Again, that's dollars back in the investors' pockets. A lot of real estate development projects for investors, there's a demolition line item in there. We generally try to get that taken care of before we bring it to our investors, and in this case, we were able to get that done.
Yep. Yeah, no, we're very fortunate we've been able to work with West Dallas on getting this done. I will throw a slight asterisk on here. We are finalizing the negotiations for this, but we're just about at the finish line. So we fully expect this to happen. The tax increment that's going to be generated from this project will be seen by the city and the community in 28 years, which in the grand scheme of things is not that long of a time. But for us right now, we get to realize those TIF incentives for our investors who will be paying zero property tax on this building for the next 27 years. Not only does that help with cash flow right now, that helps with the valuation of the building if we were to sell in 4 to 10 years. Whoever the investment company is that likely will come along and buy the property from us will look at those next 17 to 22 years and realize that they're going to be receiving those tax benefits, and therefore the value of the property will increase. So all around, it's a great thing for us. We're very excited to partner with West Dallas and get this project to the finish line. Here's our capital stack. We can go over this quickly. Essentially, it's going to be roughly a $37.4 million development. We're targeting a loan of 25 million plus, 25 to 26 million, with 11 to 12 million of equity. It's a slightly moving target when we're this early in the phase of construction, but we'll be honing that in. I think we'll look likely much more like $11.5 million of equity at the end of the day. Here's all of our line items. If you'd like to see any of this in depth, we have a full investment breakdown that we are more than happy to send to you.
And I would like to throw an asterisk on this. Our uses chart here is not drawn to scale. So just take that with a grain of salt.
Our investment structure is the same as it is for all of our deals. We like to keep it simple at F Street. We have a preferred return that goes to you, to our investor, before anything else happens. Once you're fully caught up on that preferred return, we start paying you back on your initial investment. So if you earned $100,000 in year one, we'd owe you 8% on your money, so $8,000. If we're able to pay that, we pay you back, and then we can start paying down your $100,000 investment. So if we have $18,000 total to distribute to you, 8,000 of that would go to your preferred return, and the next 10 would go down to paying down your investment. Now, a split occurs at the end of the day, right, between F Street and our investors over here, but that split doesn't occur until you've gotten all of your preferred return current and you've been paid back your investment. And we like to do it this way because it's simple. There are no IRR waterfalls. It doesn't get murky. It's easy for our lenders to understand. It's easy for our investors to understand. And it shows that our intentions, our motivations are in line with you. We want to get you paid because that's the only way that we can make a profit, right? And we are in the business of making a profit as well, as well as you. So I don't know if we need to go into any more detail on that, but Brian, if you want to walk through the investment timeline and then we can wrap this up.
Yeah, absolutely. Right at the beginning of this month, so August 2025, we opened this up for investment. We're currently about 40% raised. We are going to look to finalize this investment at the end of October. So, as you go to your Halloween party, you can tell all your friends about the awesome investment that you just did, F Street 92 LLC. And then right away in November, beginning in November, before the ground freezes, those garden style buildings, the 42 units of garden style, those will get under construction. We've built these before. We're using a general contractor we've used before on these. And to complete 2 garden style buildings, we expect it to take about 7 to 8 months. It sounds crazy fast for modern day construction, but it is. Those are results that we've seen before. And then in the spring of 2026, we'll be starting on the mid-rise building, with that completing in late spring, early summer of 27. And we have a property management company we work with on all of our new build in Wisconsin here. And they do a really great job at, hey, we're 3 months out from construction being done. We're going to have a professional website. We're going to have a leasing agent hired. We're going to have, all of our materials ready. So instead of, when the building opens and we get our certificate of occupancy, it's going from 0% leased to 100% leased. We might be going from 20, 30, or 40% leased, then to 100% leased. And the faster we can get the buildings from, breaking ground to call it 90 to 95% occupied, the faster we can do that is the faster we can pay you guys as the investors. Once the building's stabilized, we'll potentially look to refinance the asset. And then eventually, there's always a sale event at the end of the day, to fully, get all of the dollars back to the investors along with a big profit, and then on to the next development.
Yeah. Awesome. Well, I think that's about all we have for today, but we appreciate you joining us. We really do. We have maybe a couple of questions, Peter.
That's a great question and a great catch. So the building that is there is called the Gonzaga Senior Center. This is what the question was. What is the gray building right there? That's called the Gonzaga Senior Center. That was not part of our property. That is its own parcel. So we are building right around it. We have, some shared parking with them. But we think, all in all, it's going to be a positive thing that, they're there and we are there.
Yep. Yeah, so the question was, what sensitivity analysis has been done for construction timeline, vacancy modeling, and what was the third, Peter?
Just compare the optimal
And just compared to the optimal scenario. So you can find all of that in our investment packet. I don't have the exact numbers off the top of my head. I'm not a computer, unfortunately, as much as I wish I were integrated with AI. But we do have a lot of sensitivity analysis that we run. Along with that, all of our base assumptions, especially with the vacancy, with costs of construction, we try to be as conservative as we can, right? We include large contingencies in all of our development budgets that if those don't get used, those just get distributed back to investors at the refinance or at the end of construction, or they can be put towards operating reserves for if we do have longer vacancy than projected. But we never project vacancy or occupancy to occur faster than we've seen it happen in real time. We usually like to give ourselves a few extra months further than what our real prediction will be for filling up our buildings.
Yeah. And on the construction side of things as well, I just want to point out, like we really pride ourselves in the vetting process of our general contractors. We have a lot of really good relationships with best-in-class general contractors in the Milwaukee area.
Yep.
And we've kind of worked with several of them before. We're using one that we just worked with on a previous project. So in terms of construction timeline and construction cost, we feel very confident that they're going to come in on time and on cost.
Yep. Yes, the question is, will I see any distributions paid out until the project is completed? With our multifamily developments, we have several components of construction and lease up that usually takes between 8 to 16 months. And with this being a large project, we're delivering 147 units. We're going to be closer to that 16-month time frame. So construction will take place, and then we have to lease the building up, as Brian was just talking about. So during that time, there's no true cash flow that will be resulting from the property, because even though the garden style over here will be delivering first, those rents won't be enough to cover our development budget, to cover our expenses that we're incurring for the whole project. So until we're closer to that 90 to 95% stabilized, that's when we'll start to see cash flow come in. And very likely what's happened with a lot of our multifamily in the past is the first cash flow you'll see is that hopefully large distribution from a refinance, right? We're increasing leverage based on the increase in value that lenders see in the building because it's fully leased up, NOI is high, net operating income is high, and we're able to hit different debt service coverage ratios that we weren't able to hit before. So we're able to increase leverage, and the gap between the construction loan and the new loan is what we can hopefully pay out to investors in that first distribution. So can't guarantee that's exactly how it's going to go or the exact timeline, but very likely, that's our thesis is that'll be our first big distribution to investors. So hopefully that makes sense. And if it doesn't, or if you want to go over any of our sensitivity analysis, reach out to me, lane@fstreet.com. I'm happy to set up a Google Meets call with you. We can go over my model and talk in depth about what things look like based on an assumption of, hey, we don't start leasing until month 20, or our occupancy isn't reached fully until month 36. We can go over all that. I'm always happy to take time with investors and walk you through our assumptions.
Yep, great question. So, we're going back to depreciation here. Can depreciation only be used in that tax year, or can I use it in all subsequent years? Great question. So, any unused depreciation. So, if I invested in, F Street XYZ this year, and let's say I have $10,000 of passive income, and I have a $50,000 passive loss, I can use $10,000 of that depreciation. And then $40,000 that passive loss is going to carry into the next year and the next year and the next year. Or if you have other passive investments that also are giving you passive income, it can go to those investments as well.
Awesome. I'm looking out the window right now, and Nvidia is up to 180. So congrats if you're invested in that. You will have to pay taxes on that though, so invest in real estate. But if you have any other questions, please reach out to us by email. We're very thankful that you joined us today. Again, Lane and Brian with F Street. Thank you for your time, and we hope to see you again soon.
Thanks, everybody.